Hello, my name is Chad Zager. I've worked in the area of helping customers with accounting needs for approximately 20 years, the last 3 of which being at GreenStone Farm Credit Services, working as the VP and Managing Director of our tax and accounting services. During this video, we discuss in the following: the importance of good record keeping, including reviewing some entry-level detail on accounting, some key terms for you to know, in addition to discussing the benefits of good record keeping for your farming operation. Then we'll review some best practice tips on how you can effectively manage your farm books and records. So why is good record keeping so important? The analogy that I commonly use is, would we play sporting events without keeping score? There's no way. We want to know who won or lost the game, and we all want to be the home team on the scoreboard that you see. Keeping good books and records is your way to keep score of how your farming operation is performing. Farmers that know their numbers are able to make educated business decisions. They're able to have the ability to be forward-looking. They're able to use numbers to support their gut business decisions. They're able to plan for tax payments, distributions, and impact on personal life. They're able to maximize profit in good times and minimize losses in difficult times. And last, when working with a lender and a farmer provides good information to that lender, a lender can make an educated credit decision with a quicker turnaround, potentially at better cost to the farmer via lower interest rates. So when you're starting out in your operation and you're looking at the status of your record keeping, most of you will begin on the far left end of the spectrum, and that's where checkbook accounting resides. When you're doing a good job of keeping track of your checkbook, you're recording transactions. You're writing those transactions down. You know where your balance is in your bank account. If you have a line of credit or debt, you know what those balances are, and you're tracking all the transactions associated with those accounts. You're keeping good records of that, and you know how much you have available to spend. Moving up the spectrum, the second step would be to start utilizing technology. So go from writing that down or entering that into Excel and start producing financial statements. Maybe, export from a bank account or a credit card and importing transactions. Try to be efficient. Use a tool that can produce financial statements for you. The next two items included on the record keeping spectrum are accrual-based record keeping and U.S. GAAP level record keeping. We're not going to talk a lot about that on this video, but that's where you're recording receivables, inventory balances, you're tracking your payables. Those would be the next steps on the record keeping spectrum. I think what's important is to walk before you can run. Make sure you get good at checkbook accounting. Make sure if you're using a system, you're using it well, you're inputting your balances in there, you're getting information out of it that can help you with your business. So there are some key financial schedules that I wanted to share and kind of explain what each one is. So the first one on the left side of the slide is a balance sheet. A balance sheet is a statement of assets and liabilities and equity for your farming operation. This is at a particular point in time, so it's a snapshot as of a certain date. And measuring your balance sheet against historical periods helps you assess your operation. The goal is for your equity to always increase, which means that your assets are increasing quicker than liabilities. The second financial schedule included on the slide is an income statement. And what an income statement does is it shows the company's revenue and expenses during a particular period. So in a few minutes, I'll talk about the importance of consistent reporting. I've presented the Schedule F for the income statement for reference. And I think at a minimum, customers should be coding and tracking their income and expense items consistently. If you've got a good farm chart of accounts, that's great. Use it and be consistent with it. If you don't, at a minimum, you should line your expenses up to match the Schedule F. That's what's used for your operations on your income tax return. The third financial statement here would be the statement of cash flows. And the statement of cash flows shows changes in your balance sheet accounts, and statement of cash flows is a financial statement that shows how changes in the balance sheet accounts and income affect your cash and cash equivalents. And it breaks the analysis down to operating, investing, and financing activities. Now that can seem kind of complicated. What you need to think about with the statement of cash flows is it shows where all your money came from and where it went. So at the end of the year, a lot of times customers will say, well, I made this, but I've only got this left in my bank account. Where did my money go? That's what this statement does. It paints that picture of the sources and uses of your cash. These are the three most important financial reports to make sure that you understand. Tracking these reports over time allows you to measure yourself to where you've been in the past, and it helps paint a picture of your progress. When you understand your historical results, you can utilize these schedules to really help you plan where you want to go and how you want to improve your operation. So now let's take a little bit of time to go through some best practices for your operation in the area of record keeping. First recommendation I would make is to separate your business transactions from your personal transactions. When you do that, at all times, you have an accurate representation of how your business is performing. You don't have a number of personal transactions recorded in your business accounts that are muddying the waters up. You don't have personal transactions in there that maybe are skewing the results of the business operation. So keeping those separate, at any point in time, you can look at your numbers and say, okay, how is the business really performing? When you mix the two, it costs time and money as well, because combing through the transactions, if you've got personal transactions in there to pull them out as personal draws or distributions, or taking the time to explain what's personal versus business to your lender, that takes time. So I would recommend doing yourself a favor and just separating those transactions out from the beginning. Have two bank accounts or have a credit card that's only used for business purposes. If at all possible, budget yourself a draw from your business and use that for your family living costs versus recording them through the business operation. Now, there are times when the lines can get blurred a little bit between personal and business finances. For example, you may have some costs that are personal, but you can allocate them to your business. Maybe that's utilities or internet or other business expenses. And in that case, I would recommend paying for it from your personal funds and then allocating it over to the business. But in all instances, keep your receipts, take notes of everything you're doing, and remember to always consult with your tax professional because every business is different. Next recommendation would be decide on a platform that you're going to use to document and account for all of your record keeping. Doing it on paper is fine as a start. You can definitely use Excel to produce financial statements if you're knowledgeable in Excel and you're confident in using it. You've got to have those skill sets to be able to do it. It may really make sense to investing in a third-party software. This allows you to do the data entry and benefit from the platform to provide financial statements. And then if you don't want to or don't think you have the ability to complete your accounting, it's always an option to consider obtaining your financials from a third-party provider. There's many customers that we have where we do a wide range of services for them, anywhere from simply reviewing what they've inputted or working and completing full service accounting needs for them. If you're going to be responsible for your own record keeping, the next recommendation I would make would be to really devote time to it. you've got to carve out time to complete your accounting. You need to make it simply another integral part of your business, because it is. So devote time to it, do it consistently, and then I've broken down some of the tasks that you have in the area of accounting by when you should be doing them. So recommendation is to check your bank and credit card balances daily. You know, log into your accounts, look at where you're at, make sure you're always on top of those balances. And then weekly, get in, record the transactions. If that's writing them down on your register and putting them into Excel or putting them into a platform like QuickBooks. Don't let that pile up too much so that it becomes overwhelming to you. You know, get on that weekly and input those transactions. And then on a monthly basis, the recommendation would be to reconcile that bank account balance. Look at what's in the bank and what deposits in transit or outstanding checks you have. You know, reconcile that out and close it. If there's other balance sheet accounts that have moved, take the time to reconcile those as well on a monthly basis. At a minimum then, on a quarterly or annual basis, you should be printing and reviewing your financial performance. Printing off those statements that we just went through, the balance sheet, the income statement, your cash flow, and looking how are we doing? How are we doing compared to last year? That's a key, at least on a quarterly or annual basis. So everybody's lives are busy, you know, self-employed people even more so. Farmers are on another level. You know, so the recommendation would be, you know, do what you're good at. When possible, use experts. If you need veterinarian help, marketing help, fertilizing, tax and accounting, you know, you need to have a plan, but most times you're better off when you can use experts and free your time up to do what you're good at. Next recommendation, which I've talked about a little bit, is to really be consistent with your accounting. And it's more so around the area of income and expense reporting. So having a farm chart of accounts is huge. That allows you to record transactions and the right types of accounts. And there's different services and reporting that GreenStone offers with benchmarking that when provided, you can look and see how am I doing compared to my peers. So being consistent, recording a farm chart of accounts, or at a minimum, in line with how you report for your IRS purposes on your Schedule F. That's a must. And doing that over time, you really benefit from that consistency. When you review year over year, anomalies stick out, and you'll find yourself looking at different expense transactions, different expense buckets, and asking questions. You know, why was repairs and maintenance up so much this year? Did we really spend less this year on utilities? When you track that year over year, you can ask yourself those types of questions and learn from the performance in the past and really dig into it and make improvements. Another recommendation would be utilize technology. So utilize technology to help for efficiency purposes whenever possible. If you can export your transactions from a bank site or a credit card, do that. If you can avoid inputting any data again, then you're saving yourself time and you're minimizing human error. If you've got bill payments that are consistent, where you're always paying the same amount, or you know it's due by a certain date and you're going to pay it, automate those bill payments. Save yourself time there. Set them up so that they're just going through and being deducted from your bank balance. If you can get a credit card with rewards instead of writing checks for every transaction, I would recommend that too, especially if you can get one with cash back, because that really adds up. And we see a lot of benefit with customers that are using credit cards. At the end of the year, they'll be surprised with the rewards or the cash back that they've earned by using those during the entire year. So last recommendation here would be, you know, you've gone down the path, you've got a system, you know, you understand your financials, you're inputting it timely, really, you know, you really understand your balance sheet, income statement, and cash flow. Now utilize that information and measure yourself at different periods in time. Look and compare your balance sheet from this year to last year. Compare your income statement from this year to last year. Use it as a way to budget as well. Take those results and make a plan for the upcoming year. It'll help you look when you have major transactions that are coming up or equipment purchases. Looking at your historical results and seeing where you can improve performance, all it can do is help you from a planning perspective. So a quick recap, best accounting practices: definitely separate your business from personal. Dedicate time to the accounting. It's just another part of the business. It's integral, and you got to do it timely to benefit from it. Be consistent in your record keeping. Make sure you're recording transactions to the same expense classifications so that you can look at it year over year and know how you've done and where you can improve. Utilize technology to save yourself time. And then when you've got the information in the system, you've got to review it. You've got to look at it, and you've got to see, you know, how you can utilize it to help your business operation. So GreenStone is obviously extremely proud to support agriculture, and we're dedicated to helping the next generation of farming succeed in today's ever-changing and highly competitive marketplace. We provide a variety of resources to young, beginning, and small farmers entering the industry to help overcome the challenges of establishing a farm. A young farmer is someone who is less than 35 years of age. Beginning is defined as a farmer who's been farming for 10 years or less, and a small farmer is someone who makes less than $250,000 in annual income. So one of the resources that we provide to our young, beginning, and small farmers are Grow Forward grants. Each year, we provide up to $40,000 in grants to assist qualifying young, beginning, or small farmers with costs associated with educational seminars, workshops, conferences, business consultations, and even GreenStone's tax and accounting services. GreenStone members who qualify as a young and beginning or small farmer can apply for up to $1,000 to use towards their first-time accounting services with GreenStone, and non-GreenStone members who qualify can apply for up to $500. This is a great opportunity for young, beginning, or small farmers to meet with our tax or accounting team to ensure their farm is on the right track. You can find more information on our grants and see if you qualify by visiting the website listed on this slide. GreenStone's tax and accounting services are in all different areas, and we really range in the spectrum of support that we provide. Some customers use us just for accounting, or just for payroll, or just for tax return preparation. But we are a full service accounting department, and really can plug in and provide support wherever necessary based on your operation. So thanks for listening today. I really hope you can take something from the topic to help in your record keeping, in your farming operation. If you have any questions about GreenStone, our accounting or financial services, or anything discussed on this video, feel free to contact me at the number provided on here. Thanks. Have a great day.